I'm Owen Bigland. This is the Inside Edge video blog. Okay, viewer mailbag. Had a viewer ask, Owen, I've noticed there seems to be a trend forming with people advocating not to buy real estate and just invest the down payment in the S&P 500. So I'm not sure if this advisor is saying forego buying your principal residence and invest in the S&P 500 or investing in real estate versus the S&P 500. So if you guys know, I'm a huge believer in investing in the S&P 500. If you've read my book, Along for the Ride, and plugged this book for a while, I give you my roadmap on how I became a multimillionaire at a pretty young age, hit my crossover point where I could quit working if I so choose and just live off the cash flows. The income coming in from my rental properties and the dividends coming in from my stock portfolio. I currently own, if you've read my book, I probably won't have over $500,000 US in the good old Vanguard S&P 500, the VOO, which is an incredible ETF. It's done very well the last 15 years I've held it. This year alone, it's probably up about 22%. But it's time for a refresher. I've done lots of blogs on this. I talk about it in my book, The Steps to Financial Freedom and How I Did It. The first step, if someone is recommending that you put your money in the stock market, whether that's the S&P 500 or whatever else, and forego home ownership and rent, that is very bad advice in my opinion. You should do a 180 and get out of there because they have ulterior motives there. Stock brokers definitely do. I've seen many cases with this where forget about buying the house, give us that $200,000 down payment and we'll put it into a basket of stocks that I'll manage and charge you 1.5% to run. But the first step towards financial freedom in Canada, it should always be buying your principal residence. Start with a 1-bedroom on SkyTrain and then you can move up the ladder from there. That's how I did it. I started with a small wood frame condo, lived in that for 3 or 4 years, moved into a townhouse. From there I moved into a bigger condo, and then from there I moved into a detached house. But in Canada, the big advantage were a couple of things with home ownership on your principal residence. A, you're taking advantage of the leverage. I've done lots of blogs on leverage. I've talked about it in my book. A lot of people don't understand leverage. You have to be careful. You don't want to over leverage. Although in Canada, that's pretty much impossible with the banks and getting money here and the stress test and everything else. But leverage is the greatest wealth accumulator or wealth multiplier you can have. And learn about how leverage works. But that's one of the big advantages to buying and holding real estate is using that leverage. You put 20% down and take possession of the home. But the other big thing with owning your principal residence is taking advantage of that principal residence exemption. And I've done lots of videos on this as well. The only true tax shelter we get in this country, you buy a house for a condo for $500,000, you sell it 15 years later for $1 million, that $500,000 capital gain goes to you tax-free. And the principal residence exemption has minted more millionaires and multimillionaires in this country than all other sources combined that I've often pointed out to you guys. So that should be always goal number or step number one. Own your principal residence, save for that down payment, get into home ownership, and then you can ride the market up. Renting long-term, nothing wrong with renting short-term, and you might have to rent while you're saving for that down payment, but you want to get into home ownership as soon as possible. Again, I don't want to go on too much on it here because I've probably done 30 or 40 blogs over the last 12 or 13 years on the power of home ownership and owning your principal residence. But step two, if you guys read my book, step two, I don't say jump into buying an investment unit. Step two should be maxing out your TFSA and your RRSP in equities. 100% in equities, I think, is what you should be in, especially if you're in your 20s, 30s, or 40s. When you get into your 60s or 70s, sure, you can start to own some bonds and some interest-bearing vehicles there. Although, you know, I'm getting into my 60s here pretty soon and I have never owned a bond and I never will because I've got a large enough portfolio that I don't need to. And that's kind of how you can bulletproof your financial freedom, where you can just live off those dividends and you don't even need to sell shares to live off of. Again, it's all in my book and how I did it. But Step number two should be, buying the S&P 500, the VOO through Vanguard. I'm a big fan of the VIG, the Vanguard Dividend Appreciation Fund. I have a lot of money in the Triple Q, which is the NASDAQ 100. I have a lot of money in the Schwab High Dividend, the SCHD. And then I've got some Canadian ETFs. And then, as you guys know, I also own a lot of individual stocks: Amazon, Meta, Nvidia, Google, Johnson & Johnson, Starbucks, Costco, Visa, all the Canadian banks, TELUS, BCE. They're all, most of them are paying me a fat dividend every quarter, and they keep increasing that dividend. So that should be step number two. Get a good handle, and I think at least have your TFSA and RSP maxed. Then, after you've got a good handle on your retirement funds and they're in equities, then you might want to consider an investment property. Again, use that leverage again. You're going to have to put 20% down. Get a good realtor. Get a good quality one bed, because I think that is going to give you your best cap rate. It's going to be the easiest to rent. And then just sit on it. Like I say in my book, and good things will happen. Don't worry about the ups and downs on the stock market. Pay no attention to it. It's less volatile in the real estate market. And the nice thing about the real estate market is you don't have a TV show like CNBC or Bloomberg that's giving you a stock quote every minute. You don't get that with your real estate. So it's a little bit easier to hang on to it and not be influenced by day-to-day price swings or even year-to-year price swings. But those are your three steps. Principal residence first. Max out your TFSA and RSP, and the best way to do that, I tell you guys, is just index investing like this guy says. Buy the S&P 500, buy the VIG, buy the Schwab High Dividend. In my back of my book, I give you all my holdings in Canadian and US funds. A few things have changed there, but pretty much all the same. It's been pretty much the same portfolio for a long time now. I just keep adding to the names. And then the third and final step would be maybe perhaps to buy an investment property depending on your situation. But, I'm a huge believer in the stock market. I've done lots of blogs on Saturdays. I love both real estate and stocks. Half my net worth is in each. I've got half my net worth in real estate and the other half in equities, Canadian and US. Let's see. Probably 85% of my portfolio is in US equities in US dollar, because that's where the action is, that's where the growth is, and that's where the world's best companies are. In Canada, we're pretty limited. Outside the banks, the telcos, maybe you could own a bit of Enbridge or Suncor or a Fortis. But I own XEI, which is the TSX 60, and I own XEI, which is the Canadian High Dividend, and I own XIC, which is the TSX 60. But that only makes up about 15% of my portfolio. The other 85% is in good old-fashioned US stock, individual stocks, and then ETFs, index investing through iShares and Vanguard. But the stock market, it's very misunderstood. You could buy my book and you can watch my Saturday blogs and all the blogs I've done over the year on understanding how the stock market works. You've got a huge advantage as an individual investor. I know if you listen to these experts on TV, they'll tell you you need them to navigate you through these choppy and unpredictable times. Well, we're always in unpredictable times, and you do not need them. 90% of those turkeys cannot beat the S&P 500 every year. And if every now and again they'll get lucky and beat it, but they can't do it consistently. So for that reason, most of you, if you just buy a diversified basket of low-cost ETFs, index invest, then if you've got a real interest in it and a passion for it like I do, you can start buying some individual names. But I would probably have the majority of your portfolio in index funds. I've told you guys here, in the last 5 years or so, I've done blogs on this. I've slowly been shrinking down my individual portfolio names and just putting it straight into the indexes. Over the next 5 years, I will probably have 90% of my portfolio in a basket of ETFs because I just want to set it and forget it. When you own individual stock, you've got to pay attention to them, see what's going on with it. I'm not trading in and out of these names, but you do want to, pay a bit more attention to it. I've got some stocks this year that have not performed well. Not all my stocks are going to be winners. And that's the nice thing about index investing. You're going to have some winners in there, some losers, but overall, you've got a basket of 500 names and it generally just keeps thumping forward and moving up. Not every year. There'll be good years and bad years, but you don't have to think about it. And that's the good thing about index investing. And again, each of them will have its job. The S&P 500, which 40% of it is the Magnificent Seven, so it's a lot of growth names in there. But you can counter that with something like the Schwab High Dividend, which is going to yield you 3.25%. It's going to be more mature companies, less growth, more dividend appreciation. Same thing with the Vanguard Dividend Appreciation Fund or the VIG. So you balance, you get a nice basket. Each one has its job. Again, though, it's really free money when it comes to the stock market. As long as you know how to invest properly, you're an investor, you buy and hold, and you don't trade, you don't get spooked when the markets are down. That's a recipe for disaster and for subpar returns. But stock market's great. S&P 500, I own lots of it, but I also own lots of real estate, and no plans on selling any of my real estate in the near future. One of these days I will, as I retire. But they both have their advantages. The big advantage to real estate is using that leverage. It's tangible. For a lot of people, it's a little bit easier to understand because it's hands-on as opposed to the stock market. I'm Owen Bigland. As always, thanks for watching. Thanks to all my new subscribers. I'll see you next week.